Hello everybody, I am Sunil Gabhawalla, Vice President of the Bombay Chartered Accountants Society, and I am here to give a small presentation on the GST implications on cooperative housing societies. I know this is a very debatable and a touchy area, but because of its widespread importance, BCAS has thought it appropriate that there should be a small education on this aspect through a concept of a short educational video. Coming to the topic per se, GST, as you all know, has multiple trigger points. And two important trigger points or the constituent trigger points are the aspect of paying a tax on receipts or incomes, what we generally loosely say as outward supplies, and a tax on payments or expenditure, which is inward supplies, where you have this demon of compulsory reverse charge in certain cases. Coming to the concept of tax on receipts and incomes, which is where the major aspect of societies comes in, and the question which is very frequently being asked is, every cooperative society raises a monthly maintenance bill, and whether that maintenance invoice or the memo which has been issued to the member, whether there should be a GST applicable on that document. The fundamental principles of taxation are very clear. GST is attracted on supplies of goods and or services for a consideration in the course or furtherance of business. So there are three important conditions whenever you talk about a tax on a receipt. And the key part which we need to examine is, are these three conditions satisfied in the instant case? Is there a supply of goods or a service? And that is where we need to go back to understand what is the meaning of a supply of goods or services. One thing which is very evident, and I think there is no doubt, is that there is really no supply of goods. However, is there a supply of a service by a cooperative society to the member? This has been a touchy issue. Even under the income tax law, there has been a lot of litigation in the past, but as of today, the proposition is well settled that when a maintenance receipt is collected by the society from the members, it does not amount to a earning of an income. There is a concept of mutuality wherein one says that a person cannot earn out of himself, a person cannot supply to oneself. And that principle, even under the erstwhile service tax regime, has been debated by various societies, and matters have gone to the courts. Till today, we have a few decisions from the high courts, prominent ones being the Ranchi Club from the Patna High Court, which is now pending before the Supreme Court. And therefore, an important proposition which one may like to take is to say that vis-a-vis the supplies from the members, there is a principle of mutuality applicable, and on the grounds of mutuality, any collection which a society does from its members is not a subject matter of GST at all. Therefore, essentially, if a position of this nature is taken, a society ends up paying GST only on receipts from non-members, like a tower rental or an electricity recovery from a third party. And that necessarily is very limited in terms of its scope. However, this is one position which is going to be litigative, and each society will have to take a cautious call on this aspect. As far as the government is concerned, the government is very clear that according to them, there is a supply of a service by a society to its members. Whether it can happen or not is a different litigative point, and therefore they have gone ahead to even provide for a specific exemption, which says that if your maintenance collections are less than rupees 5,000 per month per member, then GST will not apply. However, this exemption is applicable only for residential societies and not for commercial premises or industrial premise societies. Further, this exemption of 5,000 per month per member will take care of only smaller societies, because the moment you are having a monthly collection above 5,000, the entire amount might become a subject matter of GST. When we are talking about all of this, we also need to bring in one more exemption, which is the basic threshold limit of 20 lakhs per annum. Now, this 20 lakhs of course will include all your exempted supplies. So, if a society has members where some members are paying less than 5,000 per month and some are paying more than 5,000 per month, then for the calculation of 20 lakhs, the total of both of those will have to be taken into account, and not only members who are above 5,000. In that sense, 20 lakhs limit is very constraining and not really useful. One more caveat is that if a society is already registered under GST, then you don't have to look at the 20 lakhs at all. It is not applicable. It's only applying to unregistered societies. In that sense, threshold limit really is a misnomer. That takes me to the detailed tabulation of the various receipts, and there are different types of receipts which are collected. Assuming that you do not want to litigate on the grounds of mutuality, how do you go about it? A detailed clarification has been issued by the government on various revenue streams. Some of them are reasonably straightforward and fine, but there are a couple of places where one can really have a couple of different opinions on those aspects. So let's go into them one by one. The first receipt which has been clarified in the government clarification is relating to the property tax recoveries, and the government clarification says that a property tax recovery is not taxable because it is in the nature of a tax, and there should not be ideally a tax on tax, and which is correct, and therefore property tax recoveries by cooperative societies will remain non-taxable. As far as water charges are concerned, the government clarification talks about saying that if it is in the nature of a tax, it will be outside the purview of the GST regime. Now, this is a little bit tricky because most of the local authorities do not charge a tax on water. It's a fee which is basis the usage of the water, and therefore it is essentially a water charge rather than a water tax. If that be the case, there can be a little bit of a difficulty in the claim of an exclusion on account of water charges. Similar answers will apply to electricity charges as well. In many cases, of course, electricity charges are not collected by the local authority, but many a times by a private player like Reliance Energy in Bombay or in some areas. So in those scenarios, it may be very difficult to say that this electricity charge recovery is not taxable. Further, most of the times the electricity charge recovery pertains to common area maintenance or common services rather than the individual electricity connections provided in the individual flats, which are most of the times directly settled by the members vis-a-vis the utility company. And therefore, electricity charges, though the clarification says non-taxable, one will have to look at the actual facts before one really takes a position on non-taxability of those charges. That takes me to NA tax, which again being in the nature of tax, the government has clarified non-taxable. Good, and that's reasonably a correct view of the matter. That takes me to the generic maintenance and society charges, which is taxable. Again, as we said, this is subject to the exemption limit of 5,000. Parking charges, non-occupancy charges, these are all clarified to be taxable, which appears to be fine. The challenges which come is in the collection of sinking funds and repair funds, wherein the government clarification says that this is taxable. However, there are a couple of important points which we need to bear in mind before we rush ahead and end up paying a tax on this. The first aspect which one needs to bear in mind is that both the sinking fund and repair funds are statutorily required funds under the bylaws of the cooperative societies. Second, these funds are meant for very specific end use which might happen in a very distant future. Third, can it not be said that these are actually in the nature of deposits given by the members to safeguard a huge expenditure which might or might not happen at a future date of point of time. As you know, deposits by themselves are not liable for GST. Basis these three propositions, perhaps one can take an overall overarching proposition of mutuality. Perhaps one can take a view to say that collections of repair funds and sinking funds are non-taxable, despite the clarification given by the government that they are taxable. That takes me to the last aspect, which is the share transfer fees. And when again we look at share transfer fees, the question which comes is the definition of business under the GST regime includes supply of services by a society to its members. If the share transfer fee is received from a non-member, the question which comes is it in the business of the cooperative society to receive such share transfer fees? If no, the supply cannot be said to be in the course or furtherance of business. As far as the share transfer fees are collected from outgoing member is concerned, the principle of mutuality should apply and therefore it should be out. Even if we do not want to argue on the grounds of mutuality, the definition of business covers supplies of facilities or benefits to members. When a share transfer fee is collected from an outgoing member, it's not very evident what is the nature of the benefit given to the outgoing member. One might still contend that the incoming member gets the benefit of becoming a member of the society, but the outgoing member whose name is cut off from the society register, does not really receive any benefit from the society as a member by deletion of his name from the society. And therefore, a view can be definitely taken that share transfer fees are outside the purview of GST. These are, according to me, some of the complications which might arise in cooperative housing societies. Having taken a position that there is a requirement for registration, one will end up with a requirement of also a compulsory reverse charge and a lot of compliances, including the filing of 37 returns. And therefore, one has to be a little bit careful before rushing out for registrations. One should clearly exhaust all the remedies either by way of the basic exemption limit of 20 lakhs or the per member exemption limit of 5,000 or the exclusions provided on account of property taxes, and if possible also look at the principles of mutuality and also question whether and to what extent a cooperative society can be said to be in the course or furtherance of business. Thank you very much for a patient hearing. I encourage you to view various videos which the society has sought as a part of its initiative to educate professionals and the general citizens on the niceties of GST. Thank you very much.